So first and foremost, we here at Valueline hope you and your family are staying safe and dealing with this difficult time as best as possible. So today, we're going to provide an update on the coronavirus and its ongoing impact on the economy as well as the stock market. We will also discuss the actions that Valueline is taking to help our subscribers navigate this difficult time. We will then recommend one stock to buy right now, and we'll wrap things up with taking some questions. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. So before I jump into the heart of the presentation, for those of you joining us for the first time, I want to provide a brief overview of who we are at Valueline. So Valueline is headquartered in New York, and we've been providing investment research for more than 85 years. Our flagship product is the Valueline Investment Survey. This service, it's a unique source of information. It's designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The Valueline Investment Survey includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service is published weekly and is created by Valueline's research department, which includes more than 70 analysts, economists, data experts, as well as quantitative specialists. So one thing I want to highlight right off the bat is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Valueline has no investment banking business with any company, including the 1,700 firms that are included in this service. Valueline does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any of the companies that they cover. So with that out of the way, let's discuss the coronavirus, the economy, and the stock market. So the following content was prepared by Harvey Katz, who is Valueline's chief economist. So I'm just going to touch on some things that Harvey mentioned in his most recent write-up. Investor sentiment continued to shift during the month of June. To wit, after a dizzying 2-month stretch in which the Dow Jones Industrial Average went from 18,000 to 27,000 on some signs of progress in stemming the COVID-19 outbreak, in addition to a better than forecast monthly jobs report and optimism on the economic reopening, a less upbeat tone suddenly was struck, and stocks have now retreated for several days. So I think the question you would ask is, what has brought about this sudden reversal, right? First, there was the Federal Reserve, which painted a bleak picture of the overall jobs outlook and gave the opinion that it would be a long road toward a full economic recovery. Also, there are increasing concerns about the possibility of a second wave of COVID-19 infections evolving, even as lockdowns end, people return to work, and parks and beaches start to open. Finally, the stock market just may have come too far too fast and need a little breather. So that's also a possibility. Meanwhile, let's look at the economy. For starters, weekly jobless filings have continued at an unsettling pace. There have been in excess of 1 million jobless claims for 14 consecutive weeks, and the total number of claims is approaching 45 million over the last 3 months. Moreover, industrial production and factory usage remain at distressingly low levels. On the flip side, retail sales are rebounding, and a major infrastructure stimulus plan is now apparently under consideration. Where do we go from here? Well, current trends suggest that the worst may be over for the economy and that an uneven but ultimately sustainable recovery may lie ahead longer term. For now, though, there are questions about COVID-19 that will linger, and there's uncertainty regarding how businesses and consumers will react to the changing economic landscape. In all, we're cautious about the rest of 2020 and expect just modest GDP growth after mid-year. Our sense continues to be that a long-term low was likely put in during late March, and that the recent selling, which removed some froth from equities, may have been constructive. Our conclusion, with the economy and earnings generally moving on the right track and price-to-earnings ratios expected to come down as earnings improve, investors should continue seeking out quality investment opportunities. And we ask that you please refer to the inside back cover of the selection and opinion section for our statistically based asset allocation models current reading. So that was Harvey's view, Harvey Katz, our chief economist. And I just want to touch on one sentence or one section in particular from Harvey's write-up. And that is that the economy and earnings are generally moving on the right track. So we certainly hope that is the case. And maybe the odds are in favor of such an outcome, but we still have some concerns. As stated earlier, the current economic situation remains difficult, and it's going to take a while for the economy to recover. There is another factor to consider, which is something I just touched on a moment ago, something that Harvey touched on in his write-up, and that's something we don't want to gloss over. Many experts in the medical community assume that a second wave of COVID-19 cases could hit this fall or winter, which would, of course, significantly hamper a recovery, as well as introduce new problems. While I don't think that the stock market will retest the lows from February, I would not be surprised to see some backtracking. And even if the major indexes do advance from here, it probably won't be in a straight line. So just keep that in mind. Thus, we recommend that investors tread carefully and prepare for a somewhat bumpy ride. So on that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, our time-tested ranking systems, and other valuable services that we provide. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy does cross our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and for shareholders. This content is posted throughout the day on our website, and again, that's www.valueline.com. Now I'm going to walk you through how to access our site, and once we're signed in, we're going to head to the dashboard. So if you are viewing my screen right now, this is where we are. We're on the Value Line website. I've already signed in. And the dashboard, if you see my cursor here, that's where we are right now. This is the main landing page for subscribers. So under the quick links, you can click on supplementary reports if you follow my cursor right here. And these are reports that have been published by our research department, just updated thoughts on stocks that we track. We strongly suggest that subscribers visit this page often. We do continuously monitor and adjust our financial strength grades. Individual companies are dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Basically, companies are attempting to get their house in order right now, right, for lack of a better word. Consequently, corporations have been implementing cash-saving initiatives such as lowering headcounts, slashing advertising budgets, and reducing or eliminating their dividends. So those are things that we do factor into our financial strength ratings. Taking on additional debt has also been a popular means to build cash in anticipation of difficult times ahead. The consequence of this is that balance sheets have been deteriorating. So Value Line has been reviewing and altering our proprietary financial strength grades for the stocks under our coverage. If there is a change for any particular stock, these changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength along with price stability, which is another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank, a very key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information regard to our proprietary rankings and ratings, Value Line provides a user guide that can be addressed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong in lieu of broad index funds. Particularly industries and sections will cover more quickly than others during this and after the pandemic runs its course. So now I'm going to take you through a little walkthrough of the screener, and let's try to find one stock to buy right now, all right? So if you go to the dashboard, which I'm clicking on right now, where you'll find the screeners under the Find Ideas tab. If you see my cursor right there. So you click on Find Ideas. All right. So now we're going to click on Screener. If you follow my cursor again, Screener. And you'll notice that the page is blank, but on the left column, you'll see a number of different criteria that we can use to narrow down our search. So for this, first I want to point out that you have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this is of interest to you, please call 1-800-VALUE-LINE. So I was preaching caution earlier, so I'm going to create a screen that only focuses on the most stable and successful stocks under our coverage. There are loads of risk measures out there and several that Value Line offers. And I'm going to start with our time-tested safety ranks. The safety ranks measure the total risk of the stock, and it's arranged on an easy-to-understand scale of 1 to 5, with the rank of 1 being reserved for the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. At the same time, they also meaningfully participate in up markets, so that's another plus. For more information, I encourage you to read through our ranking system guide, which is available free of charge from within the investment education section of our website. Okay, so with that out of the way, let's walk through the screen. Let's see what we're going to do. So what I want to do today, since the market has been, exhibiting higher than normal volatility over the last several months, I really want to focus on stocks that are of high quality. So I'm going to focus on stocks that are ranked 1, that's the highest for safety. These are the largest, most stable equities under our coverage universe. In fact, let's go down here and look at safety rank. We'll go back up. Now I want to focus on stocks that are ranked 1. So let's click on 1. So we see what's happened already. Of the 5,700 or so stocks in our database in total, only 122 meet that criteria, that meet that top rank, right? So we've already really whittled down the list. We've gone from 5,700 down to 122. So I'm not happy with that. I want to add an additional level of security. Safety rank of 1, that's great. Let's add another level of security. As mentioned earlier, loads of companies are reducing headcount, taking on more debt, and eliminating their dividends. Thus, balance sheets have greatly weakened. Financial strength is already a factor in the calculation for safety, but I'm going to double down. So I'm going to look at safety, but I'm also going to look at financial strength. So let's look at our next criteria. I'm going to zip down here and look at financial strength. So for this exercise, I'm going to focus on stocks that are ranked an A++. Right, that's the highest rank that we have. So our financial strength system, it ranges from grades of C to A++, and it's in 9 increments, 9 steps. A++ obviously being the highest. So I'm going to go ahead and click A++ and see what happens. Okay, so we've already narrowed the list down even further. Now we're down to 53 matches. Let's take another step, right? Let's narrow down that list a little further by looking at price potential in the year ahead, right? For that, I'm going to include timeliness, which is a proprietary value line measure evaluating a stock's projected price performance in the coming 6 to 12 months. It's a pretty straightforward scale from 1 to 5, with 1 being the highest. Highest meaning it's the stock that, based on our projections, has the potential to outperform the market in the year ahead, has the highest potential, I should say. So I want to focus on stocks that, based on our projections, have the highest near-term potential to outperform the market. So let's take a look at that. So I'm going to zip down here, and I'm going to click Timeliness Rank. Okay, so let's click 1 and see what happens. Okay, so now we've narrowed it down further. We started with 5,700 total in our database. We applied the safety rank of 1. We got it down to 122 right here. We applied the financial strength rating of A++. We got it down to 53. And now by applying the timeliness rank, we've got it down to 19 cumulative matches. It's pretty good. So we've really whittled down that list. We've gotten down to the stocks that not only have, they're well capitalized, what you'd call heavy hitters, you know, the companies that have very strong finances, very solid prospects, but also the companies that have what we believe are the best prospects for the next 6 to 12 months. So I'm going to add one more criteria. I'm going to add one more criteria, and I'm going to focus on the dividend yield for our remaining pool of stocks. So let's take a look at dividend yield. And that is going to be under the valuation ratios. If you see my cursor right here, valuation ratios, and we're going to focus on dividend yield. So as you can see here, we have the dividend yield, and I'm going to set the lower bound at 2.5%. And I'm going to click filter, and let's see what happens. Okay, so now we've gotten it all the way down to 8 cumulative matches. Pretty darn good. So now we've really whittled down that list. And as you can see from all these 8 remaining companies, I mean, they're all household names. ADP, Amgen, CVS, Johnson & Johnson, Lockheed Martin, Merck, Pepsi, Procter & Gamble. All household names, all blue chips. So I am going to focus today on Amgen. And the ticker symbol for Amgen is AMGN. Before I go into specifics, please note that the screens can be saved and revisited by utilizing the Save button at the top of the screen. So now let's take a closer look at Amgen. And we're going to get some additional information from our digital page. So this is the digital landing page for Amgen. As you can see, we have all kinds of information. We have the last price, the trailing PE, dividend yield, 3 to 5 year target price range, financial strength rating. It's a snapshot. It gives you a snapshot of the company and our different proprietary marks. Timeliness rank of 1, safety of 1, A++ financial strength. And it also gives you a little information here, sort of a little write-up by our analyst about Amgen and its current and future prospects. Now I'm going to take a closer look by clicking on our last full-page report. So you do that by going over here under PDF reports and click on the most recent dated report. So as we can see, Amgen, let me make that screen just a little bit larger so everybody can see. You can see in the banner right here that Amgen is currently trading at $226, give or take, and our 3 to 5 year target price ranges from $295 on the lower bracket to $360 on the upper bracket. So this stock still has ample room to run, we think. If you look at the statistical array, the company's prospects are pretty good, both for this year and for next. It appears poised to achieve healthy annual increases in revenues, profits, book value, and other measures. All told, we think that Amgen's position is quite strong, and the company can form one of the building blocks of a successful portfolio. And it is today's one stock to buy right now. So with that intro out of the way, I'm going to go ahead and open up the floor for questions. Myself, Charlie, and Alan will field your questions. Please note that I typically don't answer complex questions about specific stocks on the spot. For this, I please recommend that you review one of our latest reports. And that, of course, can be accessed on our website, and that's, again, www.valueline.com. So for now, I'm going to go ahead and turn over the questions, open the floor up to Alan and Charlie if they want to jump in and start answering some questions.
Thank you very much, Sharif. My name is Alan House. I'm a senior analyst at Value Line. I appreciate that presentation, and thank you all for joining us today. The first question I had that was, why did you pick Amgen stock? And that's a very interesting question. We believe that Amgen is currently it's fairly positioned given the current environment due to a few factors. First, its drugs are used to treat autoimmune diseases, so therefore we think it's obviously a necessity and therefore isn't subject to some of the restrictions that other companies may have in the current shelter-in-place environment. Also, its distribution pipeline of drugs is still very strong as far as getting the drugs from the manufacturing plants to the end consumer, so that's another positive. And finally, Amgen has a strong pipeline of new drugs coming to the market. It continues to invest heavily in research and development and capital spending and so on in order to continue to churn out new products. And of course, one of the drugs on the forefront of everyone's mind is a treatment for COVID-19. And yes, Amgen is actively looking for a treatment for the coronavirus. So that's why Amgen is currently on our radar. So thank you.
Thank you, Alan. I'm Charlie Moran. I am a senior analyst at Value Line, and I received a question as well regarding the distribution of the safety ranks, and are they equally distributed? And no, like the timeliness ranks, the safety ranks are, by and large, shaped like a bell curve, and there are less number one safety rank stocks than there are three safety rank stocks that you would normally associate with like a bell curve shaped distribution.
Okay, thank you very much, Charlie. Another question that was posed to us is Amgen a suitable choice for conservative investors? And that plays right along with Charlie's answer. It is ranked number one for safety. It also carries a A++ financial strength rating. as well as has a 90 price stability rating. 90 price stability rating. It also has a pretty solid dividend, so all those factors will help to support the share price and make it suitable for conservative-minded investors. Thank you.
One of the questions we also received regards the debt level, that being 75%. And again, the safety rank is a function of the financial strength as well as the price stability rank. And so the fact that the debt seems perhaps elevated at 75%, again, we would say that Amgen's history as an A++ financial strength rated stock, it would make it a safety rank of 1, and we would not be concerned with the level of debt on the balance sheet for now.
Okay, thank you, Charlie. Another question was related to the timeliness rank and why has the timeliness rank changed. And our timeliness rank system is based on many factors, and part of that is the price and earnings momentum. And Amgen, as I noted before, has been a solid performer of late. It's held up well in a very difficult market. So that's one of the factors that contribute to the timeliness rank. But like I said, our proprietary system has many variables that go into that. But I just wanted to address that. Thank you.